Have you ever stopped and really wondered where money comes from? I mean, where does it actually come from? Because the answer is probably not what you think. It might just challenge everything you've ever been taught. Today, we're going to pull back the curtain on one of the biggest, secrets of our entire economy. We're going to ask, where is your money, like right now? How is most new money created? Not by governments, but pretty much out of thin air. And how is a whole new tech revolution completely changing the rules of the game, for better and maybe for worse? All right, let's get into it. Okay, seriously, think about the money in your bank account for a second. Not the bills in your wallet, but that number you see on your banking app. Where is that? What does that number actually stand for? You know, the picture we all have in our heads is that it's kind of like a giant, super secure piggy bank. Your money is physically sitting in a vault somewhere, just waiting for you. It makes sense, right? You give the bank your cash for safekeeping. But that's not what's happening. Not even close. The truth is, honestly, so much weirder. The vast, vast majority of the money in our economy doesn't even exist as physical cash. It's created digitally by regular old commercial banks the second they give someone a loan. It's not printed, it's just typed into existence. So let's start right there. We have to completely dismantle this idea, this piggy bank myth, because it's a really powerful story, but at the end of the day, it's just that, a story. The simple version goes something like this. We put our savings into the bank, and then the bank takes our money, that specific money, and lends it out to someone else who needs a loan for a car or a house. It's this clean, simple loop. You save, they lend your savings. Sounds right, doesn't it? And hey, this isn't just some casual mistake people make. It's so widespread that the Bank of England, the central bank of the UK, had to come out and officially debunk it. This quote says it all. The idea that banks are just middlemen is the core of the myth. The reality is way more interesting. Okay, so if the banks aren't lending out our savings, what are they doing? Well, this is where your mind might get a little blown. They're literally creating new money every single day. This right here, this quote, flips the entire script. Just let that sink in for a second. It's not get a deposit, then make a loan. It's make a loan, and by doing so, create a new deposit. The loan itself brings money into the world that just wasn't there a moment before. Let's just walk through it. Say you get a mortgage. The bank doesn't go check a vault to see if they have enough cash from other people. Nope. They just type the loan amount into your bank account. And poof, new money. That's it. It's just an entry in a digital ledger, a promise. They used to call it fountain pen money because that's all it took, a signature and a book. And this is not some little side hustle for the banks. This is the whole game. A jaw-dropping 97% of all money in the economy is this digital money, created by commercial banks. The actual cash and coins printed by the government, it's just a tiny, tiny fraction of the total. You know, this totally upends a classic theory you probably learned in Econ 101, the money multiplier. Textbooks often say that central banks control everything by limiting how much a bank can lend. But in reality, it's kind of the other way around. Banks decide to lend first if they think it's a good bet, and then they worry about getting the reserves later. The power to create money really starts with them. Now, creating money out of debt like this is an incredibly powerful engine for the economy. It builds businesses, it builds homes, but this system has a built-in weakness, a fundamental flaw, an Achilles heel that only shows up when people get scared. And that weakness has a name we all know, a bank run. It's what happens when panic spreads and everybody tries to pull their money out all at the same time. The big problem? The money isn't all there to be withdrawn. I love this analogy. Think about a small town bank. It's taken everyone's deposits and created new loans for the local baker to get a new oven and for the farmer to buy a new tractor. Now what happens if the whole town shows up one morning and demands their cash back? The banker can't just sell the oven and the tractor on the spot. That money isn't sitting in a vault. It's out there, working, building the town's economy. The whole system works on the trust that we won't all ask for our money back at once. For decades, this whole business of money creation was pretty much a closed club, run exclusively by traditional banks. But now there are new players storming the castle, armed with code and algorithms. The fintech revolution is here, and it's changing all the rules. So let's get on the same page. What even is fintech? Well, here's the formal definition.
But really, you can just think of it as any company that's using new tech to do finance better, faster, and usually cheaper than the big old banks.
And their growth has been, well, look at this chart from Spain. It's just one example, but it's absolutely explosive. The number of these companies basically quintupled in just 4 years. This is not a small trend. It's a massive shift in who controls the money.
So what part of the financial world are they most interested in? You guessed it. Look at this breakdown. The single biggest slice of the fintech pie is loans and credit. They are jumping right into the heart of it, the business of money creation, and competing head-on with the banks that used to own this space. So why is everybody flocking to them? Well, it's pretty simple, really. Fintechs are offering what the big banks often struggle with. They're fast. We're talking loan approvals in minutes or hours, not weeks. They're often cheaper. And maybe most importantly, they're serving people and small businesses that the traditional banks might have overlooked. They just offer a level of convenience and flexibility that people demand now. But, and you knew about what's coming, right? This revolution isn't without its dark side. When you bring new technology and new fast-moving players into the very serious business of creating money, you also create a whole new set of risks. This table gives us a perfect side-by-side. You've got traditional banks, slow, bureaucratic, but, and this is key, heavily regulated. Then you have fintech, super fast, but often operating in these regulatory gray areas. This clash, especially when it comes to regulation and knowing what's really going on under the hood, is where the danger is. And this isn't just a hypothetical problem. This is a pretty stark warning from a university study. The very things that make fintech so attractive, its speed, its innovation, its lack of old-school rules, are the exact things that could make it a risk to the entire economy. If no one's really watching, it's hard to know just how much risk is building up in the system, until it's too late. So we end up back where we started, but with a much clearer picture. We know that money is mostly digital credit created by banks when they lend. But now, this whole army of new tech companies is in on the action. And that leaves us with a huge, critical question for our time. In this new world, where money can be created faster and by more players than ever before, who's actually in control? The old guard? The new innovators? And is our financial system ready for what comes next?